Oh boy. All right, looks like we're hi everybody who's starting to get logged on. We are right at 2 o'clock. We'll give it just a couple of minutes to let everybody get logged in. I'm trying to keep an eye on the waiting room, let everybody in, make sure we're got everybody in and on and ready to go. And we'll get started here in just a few minutes with our quarterly market update here for the fourth quarter and end of last year. So if you'll just patiently wait a couple more minutes, we'll make sure everybody gets logged on, and we'll go from there. If you need, there is a Q&A section. You are welcome to use it anytime. Fire me off a question in the group. Many times people will have similar questions when they want to ask, so feel free to ask those there. There will also be a question and answer at the end if need be. So we'll give it just a couple more minutes to let everybody get on, and we'll go from there. Thanks for coming. All right, we're starting to get everybody to roll in, trying to keep track of everybody getting in the door. Like I said, we'll give it just 2 more minutes. We'll get started right at 5 after. Make sure everybody gets here. I know everybody's got a busy schedule, so we'll want to get into this and get going. Again, the Q&A does send me questions directly. Don't hesitate to ask questions as we go. I know these are tend to be pretty data packed. I'm going to try and make them a little less data and a more applicable to everybody's situation as we go through them today. Love feedback on that kind of stuff as I go. And like I said, here just 2 more minutes, we'll get started. All right, so that is 5 minutes after the hour. Some folks will have to join us as we go, I guess. So thank you again for joining me here for Diazo's quarterly market update, covering the fourth quarter and some of the year that was 2020. We'll dive into that. We'll look forward to what is coming, kind of what my thoughts are, what our investment committee has been thinking, and then some of the things we'd love to cover as we go. So as we go through this, we're going to cover. Oh, shoot, go back. We're going to cover 4 different subjects. We're going to cover market summary, economy and macro backdrop, the asset markets, and long-term themes. So as we can see here, we're going to get started with the market summary of where things are, where they were, and it kind of gives us a feel for what our thoughts are and what's going on. So, a tumultuous 2020 ended with more hopeful expectations. We now have a vaccine that's in the works, trying to get it distributed. Even with the recent surge in COVID-19 cases, financial markets have continued to recover, and the pandemic recession-related declines have started to soften. So that gives us some hope for a 2021 that may give us a little bit more reprieve from our overall experience in 2020. The lofty asset valuations do have us a little bit of cause for not concern, but maybe pause, with inflation being uncertain, and there could be more volatility in 2021 than in a normal year. Not in 2020, because we'll go over that. That set records, things like that. We don't expect that type of volatility, but we do expect it to be a more volatile year than usual in 2021. When we look at the macro, the global economic recovery continues. Even amid some rises in virus cases, most major countries are recovering, and vaccine hopes are fueling the return to normalcy that we hope to see. Fiscal policy continues to be extremely accommodative and stimulative in nature. Big gains for riskier asset prices, including a shift toward reflationary leadership. Policy decisions and their impact on real interest rates will probably have long-term effects. We've heard from Chairman Powell and the incoming Janet Yellen at the Treasury, and we will likely see an accommodative rate policy for the foreseeable future. Cyclical outlook remains constructive, but this is where diversification and security selection continues to be the theme that we focus on. And I focus on with our investment committee to make sure that the portfolios that we're managing on a daily basis have those aspects to them. And we'll dive deeper into that as we go. Q4 stock rally accentuated strong returns across the board for the year. So if you look, there were only two sectors in the negative for the year in its entirety. One was real estate stocks, which living here in Las Vegas, we find that somewhat interesting, as the real estate market here in Las Vegas has been the strongest that I've ever seen it. And commodities were also negative for the year. We look into gold, U.S. small cap, large cap stocks, meaning the S&P 500 up 18%. We'll talk more about that as we get into security selection. And it just overall was not, for all of the struggles that the year had, it was not the negative year that we felt like it could have been over and above what it was. So positive overall. Q4 led a lot of that resurgency, as you can see, just in these numbers. Small caps were down going into Q4, ended up. Large cap, we got 2/3 of the gains for the year in Q4. So a lot of hope in that fourth quarter of what's coming and the stimulus that's been promised, vaccines, things like that. So it gives us hope for that. But again, we want to be cognizant. The big thing that, and I touched on this just a little bit earlier, and this is something I'd like to share with everybody. So if we look here, this line right here is the 2020 stock market. So the average drawdowns since 1960 were 33%, and they took 340 days or close to 1 year. We saw a 34% decline in 23 days. So it was like being on a roller coaster at Six Flags. The minute that it drops off the big edge, we just dropped in unprecedented fashion. There was one day that I remember looking at the market in the morning, and it was down 4%. And I turned around, and I think I went and had a snack, and I came back to my desk, and it was down 11.5%. So just that absolute drop to the bottom, which could have been driven by several things, but the fear pressures really exacerbated that. The VIX hit its highest level on record in March. And for those unfamiliar with it, the VIX is the volatility index, which is the fear versus greed. And fear was just winning out in 2020 with an average VIX level 50% higher than historical average. And we still sit higher than historical averages, which is why we are still reticent about where we are in the overall market. U.S. valuations, the PE ratios that fundamentally we've looked at for the 20 years that I've been doing this. You can see here we're higher on all three cases, whether it's treasuries, stock to earnings, high yield bonds to worst. Our valuations currently sit higher, and with the decomposition of the S&P total returns, earnings has become the driving factor, or it used to be a much larger driving factor. In 2020, earnings were negative, and the multiples have continued to increase. Dividend yield has been a shrinking factor, which is when we have the conversations of growth versus value. Many times over the last couple of years, growth has won out significantly over value, which is, again, as we delve into security selection diversification, the tilts in which factor that we go with is a big part of what I do. Bond yields ticked up but remain near record lows. I think we've had this discussion with everybody that I've come in contact with. Mortgage rates are at all-time lows. You can see the nominal yield here still moving considerably south, even after a slight uptick over the last couple of months. We've got a real nominal yield of negative 99 basis points, but it has closed the gap a little bit. We've increased it significantly in Q4, and there could be some normalization of rates over the coming months. Relative performance consistent with real yield patterns. You can see here, this chart shows you as we start to see that spread deepen between real yields and performance. You can see here disinflation is listed, but disinflation is not observed in 2020. We didn't have any deflationary pressures, which was one of the original concerns we had going into 2020. Well, not going into, but in the midst of 2020 and the pandemic, there were some major concerns around deflation. I do believe that the stimulus and the accommodative nature of the Federal Reserve and Chairman Powell really kept deflation from becoming a major factor. If we just saw Treasury yields dipped low. I mean, we saw them hit all-time lows on a 10-year Treasury note. There were times this year that it was a 55 basis point payout for a 10-year Treasury note, which is the kind of the gold standard across the world. And you can see here the spreads continue to tighten. Value versus growth, small versus large, international versus U.S. And we can see here even high yield and investment grade bonds tighter, tighter, tighter. Small versus large has got a little bit of a gap, especially when we look from January 18 to June. But we can see that it's significantly moved up over the last couple of years or months. I'm sorry. One thing I always like to go into again, economy and macro backdrop, because when we're applying our portfolio theory to the portfolios we manage, the economy, the macro backdrop, what we're looking at is always a very large part of what we want to focus on and make sure that we're paying very close attention to. That's what drives things. So when we look at it, there's three major parts to it. There's a secular factor to it, and that's 10 to 30 years. Those horizons tend to be pretty smooth. You can see that's a decent line, but they all track each other pretty well. The business cycle is one that comes up most of the time. And as you can see here, that's 1 to 10 years. That's a little more volatile. We're coming out of probably the longest business cycle that we had seen from March 5th, 2009, which was the end of the financial crisis as far as a business cycle was iterated right into February of 2020. So almost nearly an 11-year run on a business cycle when most of them average somewhere between 5 and 7 years. So you can see here those ups and downs in the business cycle with the ebbs and flows. And then we get into the tactical aspect. And this one tends to bounce around a little more. We can see the ups and downs are pretty significant, but it still kind of tracks along that business cycle, but ebbs and flows on both sides of it. So when we're building a portfolio, we take all of those things into consideration and try to come up with a short-term, medium-term, and long-term overall plan. The global business cycle is a big part of the way that we look at things, and this is you can see here if we just went back, and I probably should have thrown the slide in from this time last year, because all of these bubbles were actually over here in this side on the late cycle of things. Now we're in the early expansion of cycle of things. Every country, you can check all the boxes. Everybody's kind of in this early rebounds. Credit begins to grow, profits grow rapidly, policy is stimulative, inventories are low, sales get good. It's that fire that starts burning. It's the kindling of the fire that we start to get the economy up and going. We're looking at here to get to a mid peak, and that could be a couple of years out. If we could stay in this early phase for a couple of years. I mean, if you've been with me for a long time, you've seen me do these quarterly market updates for years and years and years. We hung out right here for about 6 years in the expansion phase, and just were kind of slow and steady, and right up until the pandemic hit and kind of pushed us off that overall cliff. Global rebound of manufacturing. This has always been a really good indicator of when we look at things. You can see here the global DM, emerging markets, things like that. But here's the one we really want to focus on: new orders. Anytime these are over 50, that means there's an expansion in that market, in that country, to where the overall manufacturing is going. And the big ones we really want to focus on, obviously, are China, because there's a ton of manufacturing there. And man, the US has started to set records for manufacturing over the last probably 3 to 6 months. This gives us a really good base on this is getting things up and going. Now, when inventories are over 50, it also means that there's not a lot of addition to be made. So these two numbers need to be in congruence and continue to work together. Much like Germany, this is a much more solid footing to be on, because you need more product and you're supplying more product. Now we're supplying more, and we're starting to get to where the shelves are somewhat full. So we'll want to maintain an eye on that as we go through these next couple of months. When we look at the overall growth from China, credit growth, things like that, we like to keep a good, they are the second largest economy in the world, so we keep a close tab on that. I won't go into too much detail here, but China's economy has been chugging along quite well since about March of last year. Their domestic credit is even pulled up, even from 2019 and 18, when they were in what some people call a recession. They never hit a negative GDP number, but their GDP was shrinking at such a rate that they started to call it a Chinese recession. We'll want to keep a close eye on this as they dwarf the United States when it comes to population, but we still do have a larger output as far as GDP and input. But over the next 10 years, that is expected to get closer and closer, with India starting to play a prevalent role there too in the emerging market space. So we'll want to really maintain that finger on the pulse there to make sure that we're paying really close attention to where those things are. New virus cases have spiked all over the world. We know that here in the U.S. We hear that on a daily basis, but they've also spiked in Europe. Major European countries, you can see here that October, November, December, although their activities, it showed some resilience against it this time. Not in the same fashion as you can see with the U.S. The U.S. had a small spike back in March, but our productivity and our business offline retail activity and the climate index just plummeted through the floor on both ends. We've both seen a significant increase in cases over the last couple of months. And while the US offline retail activity took a small dip, the business climate index showed some resiliency, which is a real positive when we're talking about the capabilities of getting back on track and making sure that long-term countries return to a sense of normalcy in the next 3 to 6 months, and hopefully with vaccinations, somewhere between 6 and 18 months, we're past this and we're really into a new business cycle and hopefully a growth pattern for years to come. So U.S. near-term activity lull due to the virus outbreak. You can see here again, manufacturing index plummeted, services index plummeted, employees working and businesses open. I mean, we probably feel this more here in Las Vegas than almost anywhere in the country. The entire strip shut down, and that was something that was just to behold for 60 days. As one of the fun facts I came across during those times is there was only one day in the previous 40 years or 50 years that the casinos were closed, and it was closed for one day after John F. Kennedy was shot. Other than that, it's been a 365 day, 366 on a leap year day business with no shutdown, not 9/11, not Vietnam, not any type of war. JFK getting shot and then the coronavirus shut this city down. And I still have quite a few friends that are in the trade show industry, and that still hasn't started to come back. So I believe that we've probably gotten a front row seat to this here in Las Vegas. And for those that aren't in Las Vegas, I have friends all over the country and clients all over the country that we've talked about just the impacts that we've seen. Now the rebound has been nice, and it's been nice even with the spike in cases. We've seen again some resiliency, and hopefully that with the implementation of the vaccine and where things are headed, we'll be able to continue to see that resiliency and employees staying at work and businesses staying open. Household net worth has continued to grow in 2020, which we've seen this trend over the years. You can see one dip in 2007 and 8. We all remember that. And then from there, just kind of a beeline to about right here in March in 2019. Then we took a dip, and then again back to the growth in personal wealth and asset rallies. So, the big thing that was really interesting is, April through November of 2020, people started socking money away. Again, speaking to the American consumer and the resiliency of it, just that differential is it just shows a real ability to withstand and continue to grow, even though we're continuing to save. So that's a real positive, based on the fact that our U.S. economy is 72% consumer driven. We did see a drop in economic status for a couple of months. This had a big part to do that. People were stuffing money in their savings, which, for a rainy day, not a bad idea. We continue to see earnings continue to revise higher every time they come out, they are higher than expected because businesses are showing that resilience. And we can see here these bars on the downside are 2020, where we saw some shrink. The overall S&P saw a shrink of about 18%. 2021, we're looking at growths of 20%, including industrials, consumer discretionary, and materials leading the way, which were some of the most deeply impacted industries. Information technology, again, was flat this year, but still has potential for growth. And that, again, gets back to our security selection and asset allocation strategies. Wages and shelter key to near-term inflation outlook. So when we look at this, the big thing that we look at is shelter prices, meaning homes, places for people to live, have significantly come down. And that even started prior to the pandemic. You can see if we look right here, it was about the beginning of 2019. We started to actually see not necessarily home prices, because that is a factor in the shelter price. But when you factor in home prices and interest rate prices together, it actually costs the U.S. consumer less to shelter their family than it had previously. And then employment was ticking upward, and obviously this is something that is cause for concern. Obviously, was the coronavirus. Making sure that long term this isn't where we end up. And we've seen a nice little rebound. We obviously have a ways to go to get back to where we were. Consumer inflation expectations. So this is a survey based on consumers. And again, we've seen that fall off the cliff, and now consumers are starting to understand that there may be a rise in interest rates coming. Again, we talked about this a little bit at the beginning with Janet Yellen and Jerome Powell. They have stated flat out, we're going to see flat interest rates from the Federal Reserve for a myriad of time. And we want to make sure that we understand that, but they can't control the inflationary pressures of businesses, things like that. So we'll want to make sure we have a really nice balance there. The accommodative support of asset prices has been unprecedented. And this chart probably shows that better than ever. When we look at the billions of dollars invested by all Japan, the Eurozone, the US, and the overall total, when we hit 2020, that number just significantly goes up. Global banks injected nearly $8 trillion with a T of liquidity into financial markets. A lot of that came in support of asset prices, quantitative easing. The pace of balance sheet expansion has lately been less forceful than it was at the beginning of the pandemic, but the Federal Reserve's monthly asset purchases still are in excess of $120 billion, and they plan to continue to keep interest rates low. So something we definitely want to keep an eye on. The accommodative nature is a big part of why we've seen the recovery that we have financially. Now we just got to get the health side of it and the vaccine side of it caught up with the financial side, and then we should be in a really good spot financially overall. More stimulus still approved, more maybe on the way with an incoming administration. There's talk of another stimulus package to the tune of somewhere near $2 trillion. We saw a $900 billion package passed in late December, early January, which went back out to PPE loans, getting hospitals, protective equipment, some state support, and unemployment, which again, that's where those dollars are needed the most and made the most sense for the time to apply that. So when we see that here, we can see that the dip down here when it comes to impact on GDP we've seen in 2020. Obviously, we didn't expect it to be a flat line, but this cavern could have been far deeper were there not stimulus and accommodative Federal Reserve. The higher multiplier of spending may be on the horizon. So when we look at tax cuts from 2017, we saw a small spike in spending from individuals and corporates. The expectation is with transfers, infrastructure, and purchases should significantly increase in 2021, and that creates more of a velocity of money. The higher multiplier spending may also be more inflationary. Again, listening to Janet Yellen and the team at the Federal Reserve, we want to understand they're going to hold rates low for as long as they can. But if inflation starts to press, there may be plans to include higher corporate taxes. We've got to find a way to pay for all of the stimulus at some point. But getting through the pandemic is the first and foremost agenda, I believe, for the incoming administration and Congress. So we want to make sure that we're focused on that for the time being, and that seems to be where the main spending is going to be. So the historical asset patterns look like this: inflation, real assets, inflation hedges. Fiscal and monetary policy is easy. Reflation, we start to tighten a little bit. Weak growth, fiscal monetary policy starts to get tighter. And disinflation, it's probably over tight, and you want to be in safer bonds and U.S. large cap. This is where we've probably been for the last 2 years, which we'll get into as we delve into this further. Business cycle: the U.S. continues to recover from a brief but extremely sharp recession. Monetary policies appear to remain abundant in their support and accommodative in their interest rate environment. Some of the risk benefits of economic recovery have not accrued equally. We've seen that divergence in the K-shaped recovery we've seen in the tech space versus the overall value space, and that's part of when we talk about the returns that we've had for the year was bifurcated by that. The asset allocation implications of the overall market assessment is focused on diversified and disciplined investment strategies. I know I've had that conversation for 10 years with many of you. Maintaining a disciplined investment strategy. We know we buy quality companies. We want to maintain that. High valuations imply a more attractive intra-asset class tilt, a more selective inter-asset class positions. That gets back to the security selection, and I've got a couple of slides we'll go over about security selection here momentarily. And there could be some opportunities in small cap, value equities, non-U.S. assets, tips, gold, high yield bonds. So we always comb the world of investments to come up with what's best overall. But there may be some tilts that we have discussions about in the coming asset markets. Excuse me. Okay. I know this is very data heavy, and if anybody has any questions, please feel free to drop them in the question and answer. I'd love to answer anything as I'm going. So when we look at, again, continued broad-based recovery across assets, we talked about this earlier, energy being negative for the year, real estate being slightly negative. Financials, when we actually got down to a specific sector of financials, was negative as well. Long-term government treasuries were up, tips were up, credit was up, bonds were up across the board. If we own the right stuff, we were in the right space. And again, going back to that large cap, 2020, 18.4% out of the S&P 500. Business cycle is important, but it dissipates in the long run. We've talked about this before. It's not the end all be all. It's kind of a guiding mentality overall that gives us an idea of what's there and what we want to stay focused on. 10-year portfolio distribution, it continues to maintain that percentile that we want through distribution, and gives us a starting point with the business cycle. Expectations of strong global earnings. This is how we get back to normal. Obviously, when we talk about the overall economic situation and how we return to normal, earnings per share growth is a very big part of that. We can see here we were trending significantly upward in 2017. A lot of this had to do with tax cuts. Again, trending downward, and we were on the verge of stepping into some sort of a smaller recession heading into 2020 to begin with. However, the coronavirus obviously has exacerbated that. When we look at that, it wouldn't have been nearly as deep or nearly as as swift as it was when we talked about global EPS. Equity valuations are becoming elevated. So when we're talking about the elevation of equity valuations, that's price to earnings ratios. We can see here where the U.S. average is somewhere between 15 and 18. If we put a number on it, it's 17 and change. U.S. Diversified and emerging markets. So higher in a international phase. Emerging markets PEs have always run a little lower because they're a little riskier. And then the US has been kind of right in the middle. Right now, the US is running high. But again, if we look at the mainstays in our portfolios, Apple, Amazon, Google, Netflix, things like that, they are running a high PE, but in the tech space, it's kind of a more acceptable place to be. So we'll keep an eye on that as well. The dollar drop, but non-US currencies are still attractive. As we can see here on the Shiller Cape average, when we look at where we were in November versus the 20-year range, there's still a lot of room for outside of the US. The US is almost at the 20-year average as far as adjusted PE when it comes to currencies. However, everybody else is pretty much on the downside. So there is a lot of room for international growth. And we may start to tilt that way. The investment committee and myself has met several times and talked about international exposure. We're not quite there yet because of the instability that we've seen in some of the overall markets. But when we have that discussion, I always like to get everybody's opinion on it and kind of feel what they think on it, just to make sure that we're looking at this the right way. But it does appear to be quite a bit of room, cheap versus expensive, when we talk about the British pound and the Japanese yen and the Canadian dollar and the euro. We've got some room there, so there may be real opportunities for us to expand our portfolios in that direction. Value factors supported by global trends. Value stocks versus raw industrial prices. This gives us a good indication as raw prices start to move up. You can see these have kind of always been in the same ballpark. And right now there's a bifurcation of about 16% when we look at the overall difference between raw industrials and value. So we want to make sure that we're looking at this. And a value company could be anything like a GM or a Ford or, Apple is moving towards the value space, but they continue to be a growth entity. But there's just more developed companies are considered value, and we'll want to keep a close eye on that. And you can see here early annualized mid, raw industrial prices for the last 70 years. When we talk about early business cycle, this is where we're living right now. We should start to see raw industrial prices continue north, and that could mean that that value continues as well. This is one of my favorite sides, the business cycle box, I call this. The business cycle approach to sector investing uses probabilistic analysis to identify the shifting phases of our economy. So 1+ is good, 2+ is better. 1- is kind of stay away from it, and 2- is you definitely want to be away from it. If there's no boxes in there at all, there's probably it's kind of a neutral position. We won't overweight or underweight, but as you can see here, there's a lot of room to do well in the early cycle. And this one may be a little different because healthcare, we don't know what the impact of the pandemic is having on healthcare as far as a PE ratio and as far as the overall experience as an investor, where we're starting to get those data points and starting to understand them. But it could be a profitable venture. So it could go from a double- to a double plus pretty quickly in healthcare if that's how that shakes out. So, this is one of my favorite because it kind of lines out how we tilt our portfolios based on where things are and what part of the business cycle that we're in. Fixed income yields and credit spreads. This is another good one. You can see here the spread difference. And what the way that I explain this is, U.S. Treasury versus going out, taking a AAA rated U.S. Treasury bond and going out and getting call it a Ford bond. now that they're back on the positive side of credit ratings, and it may be A rated. So the spread is the difference between the gold standard, which is the U.S. Treasury, and the current bond that you're looking at. So spreads have continued to tighten and tighten and tighten and get further. And I've started to see, actually, I've been doing analysis on a lot of portfolios of individual bonds, and we started to back out of some of them for clients, because the risk factor that's being assigned to some of these individual bonds just doesn't make any sense. Typically, we like them to score from 1 to 20. I'm seeing individual bonds in the 50s and 60s and 70s range, which means there could be a real issue. One, they may have appreciated so much that they're just kind of holding water for the next 5 years while you hold them. And two, the other piece could be there's a default risk. So we always want to be cognizant of that. But when we look at the yields and spreads, yields have moved down, obviously, across the board. We can see we're lower than 4% on everything except for emerging and high corporate high yield, which corporate high yield and emerging, if we were to go back 2 years, is probably double that. Mortgage-backed securities are pushing 1%. Long-term government credit, which is 30-year bonds, is just north of 1. So really making the push down, it leaves us a lot to be desired in the yield space. So it gives us more opportunity for research and to be able to dive into those portfolios and really make a difference. Because if your overall aggregates at 1%, and we're able to find the same type of credit quality, getting 2.5, that's a great spread for us to be able to go out and get. Long-term themes. This is where we talk a little bit about how we do portfolio construction and our investment philosophy, as well as long-term over economic themes. So the next 3 slides are 3 of my favorite. The first one is our performance table. It underscores the need for diversification, meaning no, you can't pick any of these and they were the best for all or some. If you look at growth stocks, have led the way the last couple of years. But if we go back to 2008, 9, the growth stocks were the ones that were down 40% as well. So they ebb and flow, and this color structure of this chart really is been quite appealing to us, because it gives us an idea of being well diversified does mean that you're never going to end up with all the highest returns, but it also means you're not going to end up at the lowest. And that's a really big deal for a lot of people, making sure that their nest egg is safe. They've worked really hard for, and we've been able to do that. So not only do we want to properly locate and allocate the overall portfolio and make sure that we're in the right things, in the right sectors, then we get into security selection in these next 2. So this is just a snapshot of yesterday. This is the S&P 500. When we look at these, you can see the greener something is, the more positive, the more red it is, the flatter or more negative it is. So when we look at this, if you just own all of these, and this was a day that the market was absolutely flat. I think this was 2 days ago or 3 days ago. The S&P, I think, ended up 10 basis points for the day. But you can see if you owned certain things, you made money. And if you owned certain things, you lost money. So this is where our security selection comes in. And we really like to focus on quality companies and growth. And this gets even exacerbated as we go to the 1-year chart. I mean, you can look at this and you can see, there's huge outliers like Tesla at 704% for a 12-month period, Walmart at 24, Amazon at 65, Apple at 61. But then you turn around and Bank of America was negative. Boeing negative, Lockheed Martin and NOC, Northrop Grumman negative. Nike was up, but Starbucks was kind of flat. McDonald's was down. In a pandemic, I didn't think McDonald's would be down, to be perfectly honest. Pepsi flat for the year. Coca-Cola negative. Exxon, as we talked about, energy struggled in 2020, down 30% for the year. So if you pick the wrong ones here, and that's where security selection and really doing your research on these stocks comes into play, making sure that we're targeting the right ones. Because you can even see Target. A lot of people consider Target and Walmart similar companies. Target was up 67%, Walmart was up 24%. That's a huge bifurcation in your overall portfolio, and if you extrapolate that out over 10 years, it becomes a real big difference in your overall returns and your comfort in retirement. So this is our core model. When we look at this, you can see here 2019, we tracked the S&P 500 quite well. Not a lot of volatility in 2019. However, in 2020, our individual equity portfolio versus the S&P 500, we were up 25.3% for 2020 versus the 18 of the market, creating a delta of 689 basis points or 6.89%. The totality of this portfolio over the last 3 years is 950 basis points. So almost a 10% delta over the last 3 years in what we've been able to do. And that's 100% attributable to tilt and portfolio selection, as we've talked about several times today. Going into the secular forecast, this goes back into the GDP. Now that we've talked a little bit about micro, just for a minute, we're going to go back to the overall macro. This is over the next 20 years, we expect global growth to be somewhat slower, primarily due to deteriorating demographics in most countries, with developed economies likely to register the highest growth rates, meaning your India's and Indonesia's and Philippines. Again, China's been way up here at almost 10% GDP per year. Their projections are closer to 4% now. And the U.S. is kind of the standard. We've been at 2%, 2.1, 2.7 over the last 20 years. The next 20 years is looking like 2.1. Now, stimulus and things like that may have impact, but this is from the data that we're getting. A slowing labor force and aging demographics could lead to slower global growth. But with a lot of these emerging countries starting to come online and really drive some of that growth. Again, we've looked heavily into international investing, and there may be some things that we start to talk about in the coming months and years. We're just not comfortable in that aspect just yet. Want to see a little more normalcy before we start to make those decisions, because the hard hit places get hit hard, and the hardest hit places get hit even harder. Political risk, rising populist demands, these things all play into the way that we go about things. Political risk, regulatory risk, fiscal risk, global risk, monetary risk. We keep a close eye on all of these things. We're seeing an increased political influence on decisions. Over the last 4 years, the Federal Reserve has played more politics than they probably had in previous terms. And that doesn't seem like it's going to stop with Jerome Powell. It seems to be his way of going about it, and especially with a former Fed governor in Janet Yellen being head of the Treasury. So they're taking a more active role in financial markets, which was never their intention from the beginning, but it seems like they've morphed into more of that overall financial role, and we'll have to see how that works. Large deficits and rising debt levels. Our fiscal policies continue to drive our national debt numbers up, and we'll have to keep a close eye on that. A lot of people ask me, when do we get to a point that is, how many trillions of dollars in debt do we have to be before it becomes a real problem? And I don't have the answer to that. I've sat with the investment committee. We've talked about it. We're not there yet. The 1.5 times GDP would start to be a struggle, which that's probably somewhere between 30 and 32 trillion dollars on an annual basis. We're still well short of that, especially with the balance sheet of the Fed where it is. So not an overall concern, but is something that's going to need to be addressed at some point. We can't continue to add to a balance sheet on a yearly basis and just continue to have a run out of control. A little bit of deglobalization, higher geopolitical risk is what we've started to see. And we've even seen more globalized. We got more globalized right up to about 2007. And then we saw a dip and then a little comeback. And then we've kind of trended downward in the overall global imports of our GDP relationship. There are countries that we start to see bilateral flashpoints: Taiwan, South China Sea, Hong Kong. Those hold a lot of geopolitical risk, depending on how the administration that's incoming and Congress wants to handle that. And then obviously with trade, we've heard a lot about tariffs and things like that over the last couple of years. How that affects things and how we move forward with those or remove those will set a lot of policy tone. So there are a lot of things that we'll want to keep an eye on over the coming months. how the new administration and the new Congress and Senate that are in place are going to address these things that have we all these things kind of got put on hold a year ago when the pandemic hit. And I know it's not the focus of many countries at this point, but it is going to return to prevalence over time, and we'll want to watch how that happens. So the unintended consequences of extraordinary monetary policy. This goes back to our overall debt. So the intended central bank goals is substitute inflection with infusing capital into the markets is the substitute effect, ease credit conditions, reduce debt burden, improve export competitiveness. But that can lead to weaker currency, lower interest expense, bank lending goes up, consumption goes up. And if those things don't get remedied at some point, they start to be, issues. Savings go up, bank lending goes down, less productive firms stay in business, limited impact on currency are some of the negatives of the unintended consequences. So we'll want to keep an eye on that stuff. Almost there. We've probably got, I'm 43 slides in. There's 650 total. So we'll get through the, no, I'm just kidding. Last couple slides. And then I'll be happy to answer any questions. Demographics deteriorate, exacerbates fiscal pressures. Italy, Spain, and Japan continue to see the highest gross debt on record. The U.S. is currently moving in that direction. With all countries have a current upward trend, and the demographic support ratio, which is the amount of retirees to workers, continues to be a problem. There will be some sort of a problem at some point when more than half the population is retired in certain countries like Japan. You get out to 2040, and it's 1.5 workers for every retiree. The U.S. even at that point is still 3.5. But we traditionally, in 1980 there were almost 6, continued on, and then we've just seen that downward trend for years. Will policy response be inflationary? We'll want to keep, again, new administration. I know I've mentioned that several times today, but there is that is reason to pause and really put our ears to the ground when it comes to fiscal policy coming out of the new Secretary of Treasury, the Federal Reserve, as well as the administration and Congress. We'll want to make sure that we're very, very cognizant of what's going on there. We've seen that global debt as a share of GDP continue to grow over years. That private debt and public has compounded. Fed is still targeting higher inflation, but being extremely accommodative to get there. There's more stimulative fiscal policy that bumps up our risk for inflation as well. More expensive goods, labors. The Amazon effect could start to squeeze that down a little bit. More robots, more technical progress. Less people in the workforce, but less need for it because of the automation of things. And then the last thing I always like to go over is the impact of frequency feedback. If you're looking at your portfolio, this is just a huge study that Fidelity had done. If people that deeply review their portfolio on a monthly basis, they end up in a much more conservative investment philosophy than people who review it yearly, because you're reacting to loss. Checking a portfolio performance more frequently does increase the likelihood of seeing a loss, which does produce more mental agony, and it always hurts more to lose than it feels good to win. So covered a ton of data. I know I went over a lot of stuff here. I said it was going to be lighter this time. I'm not sure I accomplished that, but wanted to thank everybody for joining. As always, I appreciate the opportunity to bring this to you and spend 45 minutes to an hour with you guys. I will send out a recording of this, being as I did cover a ton of stuff here. If you have any questions or concerns or thoughts, please feel free to reach out to me individually. We can have these discussions about your individual portfolio and how it affects your plan, what these things apply to your overall plan. And we'll go from there. Is there anybody who has any questions for the question and answer section? right, doesn't look like it. Well, again, thank you for spending an hour with me on your Thursday. I'm sure everybody has much more fun things to do than talk about economic strategies and where things are. But I appreciate the time. We put a lot of work into these. So any feedback that you have on what you'd like to see next quarter, questions that you'd like answered, again, I can always take this offline. We can have a one-on-one, and I'd be happy to do so. So again, thank you everybody, and I will see you guys all soon. Have a wonderful day.